Today's session is regarding the Federal Reserve and the structure of the U.S. Central Bank. Let's get started with the session. The structure and the functions of the Federal Reserve System consists of the financial institutions that was founded in 1913 to maintain the stability and credibility of the financial system in the United States. The Central Bank of the United States is essentially known as the Federal Reserve structure. It consists of the Board of Governors, the Federal Open Market Committee, and 12 regional banks that serve as the Federal Reserve in the United States. The Board of Governors is the governing body of the Federal Reserve System, and it helps control and maintain stability, credibility of the financial institution in the U.S. economy. The Fed's president is appointed by the U.S. president and confirmed by the Senate. When we look at the structure of the Federal Reserve, it has an important Federal Open Market Committee, the FOMC, and the committee has the authority and the responsibility to conduct open market operations and implement the monetary policy of the United States, which consists of increasing the money supply, decreasing the money supply, or changing interest rates in the market through monetary policy. Open market operations is conducted by the Federal Open Market Committee, and it's the buying and selling of government securities. The buying and selling of government securities can be in two cases. The buying and selling of government securities leads to expansionary monetary policy, which helps expand the economy, or contractionary monetary policy that can contract and decrease the amount of monetary base in the economy, therefore contracting the market. Now, monetary policy is essentially changes in the monetary base and the money supply in the U.S. economy, and also affects the level of interest rates in the market. The Federal Open Market Committee is one of the most important committees within the Federal Reserve structure that helps shape the financial institutions and the financial stability of the U.S. economy and of other major nations across the world that have similar structure to the U.S. Fed. Now, the Federal Reserve structure, let's look at and break down the analysis of the Federal Reserve. The Federal Reserve is an independent agency from the federal government. It's a financial institution that governs and monitors the financial institutions in the United States, commercial banks. Now, the Federal Reserve banks are the operating bodies of the Federal Reserve System, and it consists of 12 federal banks that help supervise all of the other commercial banks in the United States, and are part of the structure of the U.S. Fed. The Board of Governors consists of 7 appointed individuals by the U.S. President, and within the federal institutions also representatives of the Federal Reserve. Now, the Federal Open Market Committee consists of members of the Board of Governors and other members of the Federal Reserve banks, typically the presidents of the Federal Reserve banks, and the chair of the Federal Open Market Committee is typically the chair of the Board of Governors as well, when we're looking at the structure of the Federal Reserve. The Federal Open Market Committee is responsible of operating and implementing monetary policy, and the Board of Governors is essentially representatives of the Fed that serve as as Federal Reserve elective members that advise or implements recommendations to Congress regarding the federal financial system. Congress oversees the Fed and all of its entities, but is an independent agency, free technically from political influence. It's a very powerful institution when we're looking at the Federal Reserve. The 12 Federal Reserve banks are the following. We have the San Francisco Fed, the Kansas City Fed, Dallas Fed, Minneapolis Fed, Chicago, St. Louis, Atlanta. We have the Washington Fed, and we have the Cleveland, Philadelphia, New York, Boston, and in Vermont. We have 12 different banks that operate as independent Federal Reserve banks that collectively, all of them consist of the United States central banking system. All of them monitor the financial structure. For example, the San Francisco Fed controls the West region, and all of the commercial banks in the West will report to the San Francisco Fed. And so for the East Coast, they control and monitor. Typically, the presidents of the Fed are financially savvy individuals that are well versed with the financial sector and commercial banking, and is one of the most elaborated structures in the U.S. The banks bank directly with the Fed. The regular public banks with commercial banking institutions. Now, the Fed has major responsibilities, and those responsibilities include controlling the money supply, supplying the economy with currency, reserve notes that most of us use for regular transactions or buying and selling goods and services. It provides with a check clearing process. It holds depository institutions' reserves within the Fed's vault. Basically, is where the banks bank. It's a banker's bank. And we have the supervision of bank members that are part of the Fed. In other words, the Fed supervisors, depository institutions, commercial banks, and investment banking that they're doing a responsible job. It also serves as a government's banker of last resort, meaning that the Fed may potentially lend funds to the government if needed, and also to commercial banks if they find themselves in insolvent situations. So number 7 is they serve as a lender of last resort to all financial institutions that need lending, or to the U.S. government as well. And it also handles the the purchase, the buying and selling of U.S. treasuries and government securities in the open market of financial trade. It's a very powerful institution when it comes to the Fed's stability and credibility of financial markets. Now, the U.S. Treasury issues U.S. Treasuries, which are bonds and other bond-like securities that are issued by the U.S. Treasury and pay interest. It's not the U.S. Treasury. It's not the same thing as the U.S. Fed. Those are two different institutions. The U.S. Treasury can issue treasuries to any individual or any country in the world, and that treasury has typically a maturity date or interest date that is paying the holder of that security, and anyone can hold a U.S. security. Typically, banks, investment bankers, regular banks, individuals, or other countries in different parts of the world. You ask, how do other countries hold U.S. debt? By the holding of U.S. securities. They buy U.S. securities, the U.S. pays some interest on that security, and any other country in the world can acquire U.S. bonds or U.S. securities, and the U.S. pays interest on those securities. Whoever owns those securities collects interest from the federal government. So breaking down the U.S. Treasury versus the Fed, the U.S. Treasury is a budgetary agency for the U.S. government. The U.S. Treasury collects taxes and borrows funds needed to pay any of government spending. It's basically, it collects the taxes and it funds government activities from that tax revenue, or it also borrows funds from the rest of the public by issuing treasuries and collecting funds to finance government activities. It manages the financial affairs of the federal government, and it does not issue or create money. It issues U.S. treasuries, the certificate. The Federal Reserve, or the Fed, is concerned with the availability of money in the economy, the credit ability of the entire U.S. economy. It conducts open market operations or monetary policy to control the monetary base in the economy, and sets requirement ratios for financial institutions given of the amount of reserves that they need to keep in order to satisfy withdrawals from any deposits that are deposited into the bank. It issues currency to the financial system, like the cash that we spend, and it takes out old currency and replaces it with new currency. It also sets the federal funds rate and all of the other responsibilities that we went over previously. Now, when we're looking at the U.S. monetary expansionary process through the federal financial system, we can expand the money supply or contract the money supply. The money supply expansion process consists of the following. The financial system creates financial transactions that stimulate deposits, and those deposits create a change of reserves in a sequence of events. If we as individuals deposit our funds into the bank, the bank keeps some of those deposits as reserves for withdrawals, and the rest are typically lended out to the public or other borrowers in the form of loans, and thereby the money supply in the economy starts to change, which is referred to as the monetary expansion system through the fractional banking structure. The money supply increases when a bank uses the excess reserves that it has within its vault to create new loans. Those new loans are issued to investors, to consumers, to households, or to any individual that borrows that loan and spends those funds in that loan or deposits those funds in another financial institution. And the process continues from there on. It continues as a monetary expansionary multiplier process. If we recall, the bank is required to keep some of those deposits as reserves. And those reserves can be held to satisfy withdrawals at any given time. And any excess reserves are either lent out to the public or to other individuals, or could be deposited at the Fed or lent to other banks. As a result, when new deposits occur through financial institutions, those deposits create what is called a multiple expansion deposit system, which in this case is an increase in the monetary money supply through financial markets. Money is created through the financial system. The Federal Reserve prints and issues currency for a certain amount, and then the banks start to lend more of that currency to the public. Some of those are required to be kept in the bank's vault at any given time. If you go to your bank, to your ATM, or to withdraw funds, they are required to keep daily reserves to satisfy daily withdrawals, or else there will be a run on the bank. Any excess reserves that they have in extra, those reserves that are in excess can be lent out. A lot of individuals says, how is the money supply expanded? Well, when you lend out those excess reserves create additional transactions. And those additional transactions, when they become recorded, they increase financial deposits, and those deposits create additional reserves for an additional bank and for additional consumers or clients. That is referred to as the monetary expansionary system through financial markets or through financial institutions. Let's take a look at the reserves. A bank can hold its reserves at their own vault as cash, or at the Fed's vault. Basically, the bank can keep, if a bank wants to keep all of the reserves, it can keep it on its vault as cash, or deposit it at the Federal Reserve, at their local Federal Reserve. They do so that people used to go and rob the banks, so that no one will take all of the reserves when they rob a bank. So the bank, any commercial bank like Bank of America, Wells Fargo, Chase, or so on, go and deposit their funds at the Fed. We as the public, we go and deposit at the local bank. And some of those funds can be kept as reserves, as cash, at any given time. The required reserves, it's the amount that they are required to keep. It's typically a ratio or a percentage. We're going to call that ratio R times the amount of checkable deposits that someone deposits at any given time. They're required to keep a certain percentage. The ratio is set by the Federal Reserve. And you'll be surprised that sometimes that ratio is very small. Whatever they have in excess, those excess reserves can be loaned out. And that's where it really becomes important that individuals understand the financial system can create additional depository transactions and therefore increasing the money supply in the market. The monetary base is different. That's the amount of money that exists in the market as the base. The money supply is an additional sequence of events that creates additional transactions. So the excess reserves is if we already have actual reserves within our banks that we need to keep minus required reserves, any extra amount can be loaned out. Let's take a look at an example. The Federal Reserve currently has a 7% required reserve ratio, which means out of any deposits that come in, 7% has to be kept as a required reserve. So let's suppose we have $250 million in checkable deposits that come into the banking system. What is the amount of potential excess reserves available for lending? So currently we have the required reserve ratio at 7%. So we take 7% out of the $250 million deposits. From there, we take the required reserve amount that is needed to be kept in the bank's vault as reserves for any daily withdrawals. This will be equivalent to $17.5 million that need to be kept for withdrawals in case someone comes in withdraws X amount of dollars. The excess reserves or the remaining reserves that are in extra is the difference. Out of those $250 million, the amount of reserves, assuming there were no reserves previously, it's $232 million and $232.5 million reserves that are available for lending. This is where the multiple expansionary process of the money supply starts to occur. If we have $235 million for available lending or available excess reserves, this can be loaned out to someone else, or the total amount can be loaned out, and it creates multiple expansion system with the original $250 million. Now, the banks typically have a basic balance sheet, and that balance sheet consists of any stocks and shares that are owned from that are the stockholders. That's a liability from the bank to the stockholders, and that equates to the amount of cash. So if we have $250,000 in cash, we create a bank with $250,000, and we're going to issue $250,000 worth of shares to the stockholders. So a bank can hold all of the following assets and liabilities. Assets is anything that is beneficial to the bank. Liabilities, anything that the bank needs to owe and has to repay back to the individuals. So within the balance sheet, we can have securities that are owned and held by the bank, government securities, U.S. Treasury securities. The bank holds them as securities, and the U.S. Treasury or the government pays them interest from holding the security. So it's an asset because it collects interest. Property, plant, and equipment, it's an asset to the bank. Loans is an asset to the bank because the bank collects interest on those loans. Think about credit card interest rates. It's like 17%. It's an asset to them because they collect 17% on the individual that has that loan. And reserves. Reserves are as an asset because it's cash or excess reserves or reserves at the Fed that they can use for available withdrawals. The liabilities include stocks or share liabilities to the shareholders or deposits. The deposits is that we deposit into the bank, and the bank owes us our deposit that anytime we go, we're going to be able to receive it. It used to be that runs on the banks were common because the bank will run out of the funds or reserves to satisfy daily withdrawals from the people that deposited their money. So let's start changing and messing around with this balance sheet and look how the bank can create more money through the typical checkable deposits and adjusting the securities, reserves, and loans, etc. So assume that we have $10,000 that are deposited in Bank of A, B of A. The required reserve ratio is 10%, and this bank requires 10%. This bank is required to keep 10% of their deposits as reserves for daily withdrawals. So Bank of A will hold $1,000 in required reserves and has no excess reserves. So right now it has no excess reserves right now. So we have the following situations. The checkable deposits are $10,000, and out of those $10,000, we have reserves that are going to be kept as $1,000. So what did that bank do with those excess reserves? Well, they lend it right away. Since there's no excess reserves, the bank has loaned the $9,000 that they had in excess reserves and converted into a loan. So basically, it issued those excess reserves right away and lend it out to the public, someone else. So that we still have the total of assets and liabilities. They have to equate. If you're familiar with the balance sheet are always have or traditionally has assets equal liabilities. So here we have the reserves are $1,000 out of the $10,000 deposits. What the bank does with the extra $9,000 left, well, they lend it to the public, and those loans are going to generate interest, significant interest. Return to the bank, which is an asset to them. That's a basic transaction within the first bank of a ability. These loans are lended out to other banks, and those banks create deposits and hold reserves, etc., or to other individuals, and the process continues and so on. That's referred to as the money supply expansion process. The Fed can engage in open market operations. And one of those is an open market purchase. An open market purchase is the buying of U.S. government securities by the Federal Reserve, meaning that we're going to buy the securities that are already out there from a bank or from the public or from anybody that holds that security. So we're going to collect the security, and in return, we're going to credit them with money supply or monetary base or reserves. So the Fed is going to buy $500 worth of government securities from the bank, meaning that we take away the security from the bank if the bank holds a security as an asset, and we're going to credit the bank cash reserves. So we're going to inject into the bank cash reserves. This is considered an expansionary money supply. We take away the security, which is just a certificate, and we provide them with cash reserves. And those reserves could be used for loans. So here we have it. So we have the checkable deposits that were $10,000 originally from the previous client, and they kept $1,000 in reserves. Out of the remaining $9,000, they issued the loans, and now we have $1,500. Well, where did this $1,500 or this extra $500 come from? Well, the bank had securities, and it sold those securities to the Federal Reserve, and the Federal Reserve credit the bank cash reserves of $500, which is now why we have $1,500. It added cash reserves into the bank's vault. So if you add this together, $1,500 plus $900, this is now $10,500. Assets are greater than liabilities. What can the bank do with this extra $500? It can actually lend out those $500 too if it really wants to. But this is injecting cash reserves into the bank. And that's key because that's where the money expansionary process begins. You inject cash reserves into the bank, and the bank can start moving this extra cash reserves and create loans or lend it out to other banks to expand the money supply, which is why it's called the money supply expansion process. Now, if the bank has those $500 in excess reserves, it can lend it out. Suppose it lends it out to Jill. Jill takes out the $500 as a loan, and Jill now has $500 with him, and they deposit it into his account. So Jill was lucky enough to borrow those extra $500 from the bank, since they have extra $500 because they sold their security. Now Jill can take that $500 loan from the Bank of A and write a check to Joe, or pay Joe the $500. Joe can go in to a different bank and deposit his $500. So Joe is going to take the $500 and deposit it into a different bank, Bank B in this case. So those $500 that were injected were paid to, were borrowed by Jill, and Jill uses it to pay Joe. Now Joe goes into and deposits into a different bank, Bank B, to his account. Now Bank B has increased his bank deposits. Bank B. Bank B now has an additional $500 that it didn't have before, and it now has $500 in reserves from those deposits. If he's required to keep 100% of those deposits as reserves, he has $500 in reserves that it didn't have before. So notice how Bank A has created an expansion on Bank B. So the money supply is moving from bank to bank and is expanding in the financial system. What happens to this $500 can continue the cycle. This extra $500 now can be relended to someone else in a different bank, Bank C, to Kathy, and the process continues then in the financial system, assuming there's no cash leakage, that they spend some of that $500. Now, money is created through what is called the multiple deposit banking expansion system in financial institution. Not the actual physical money, the transaction of money is increasing. An increase in checkable deposits, by definition, is an increase in the money supply in the economy. If we recall the definition of money, definition 1 of money is the currency that we have outside the banks, currency, the actual cash, plus an increase in checkable deposits plus traveler's check. Checkable deposits is what's increasing here. That's key. If checkable deposits increase with those $500 and continue to increase, the money supply will increase, not because there's more $500 in real cash, but because there's more checkable deposits, increasing the total money supply. And the money supply increases in the market. This is why often cases banks that increase in erratic lending may find themselves in trouble if they don't have enough money base to satisfy those loans in case those loans default. And then they have to borrow money from someone else to cover those default loans, etc. The money multiplier process helps explain how this works. Money multiplies itself. When you have money, you can create various transactions, and the banks do this through financial deposits and create an additional monetary system that increases the monetary supply. It explains how deposits in one financial institution or in the financial institution sector increases the money supply in the market, essentially in financial markets, by a greater amount than the initial deposit. This is the money multiplier effect. Money creates more money through financial systems, or the effective usage of money can create more money. Now, here we have the monetary multiplier explained. The money multiplier is equal to 1 over the required reserve ratio, which is 1 over R. The required reserve ratio is the amount of reserves that the bank is required to keep in percentages. So the money multiplier is calculated using the reserve ratio. Here we're going to use a little bit more of a conservative number, 20%. Any bank is required to keep 20% from all of their deposits. So here we have $100 in cash reserves that are deposited into the bank's vault, or $100 that someone deposited, either or. It's the same scenario. And the Fed has a mandatory required reserve ratio of 20%, meaning that the bank needs to keep 20% out of those $100 in reserves. The money multiplier will be calculated as follows. It is 1 over 0.20, which is 20%, or the money multiplier is 5, equivalent to 5, meaning that whatever reserves or deposits are deposited or credited as reserves into the bank is going to multiply by 5. How does that happen? It's through the multiple expansionary system in the financial system. An increase of $100 in reserves, in cash reserves, will create up to $500 in total money supply. So the initial $100 can create $500 in total money supply. Some of you are like, how is that happening? Well, $100 come from the cash deposit reserves that were injected into the financial system, plus $400 that were created in loans. So let's take a look at our $100 in reserves. We have those new reserves that were credited. $20 out of that is kept as reserves, required reserve, 20% over 100. The bank now has $80 extra in extra reserves that they can lend to a different person or to a different bank. The bank will have $80 in deposit, and out of that $80 they're going to keep 20% and lend the rest. And the process continues and continues and continues until it's fully exhausted. And in the banking system, we can create an original $100 reserve injection into $400 in lending. This is financial transaction. The monetary base, the real monetary base, is only $100. And the total financial transactions that have increased is $400. The monetary base is still $100, meaning that everybody here goes and attempts to withdraw. They may find themselves in trouble if the bank doesn't have enough liquidity. But the banking system can create additional money more than what initially started. This is related to real life. If you have money, you can create additional money through the money multiplier effect. The banks do this greatly. Individuals can also apply it. $100 initial deposit and reserves can create an additional $400 in lending. Let's explain this further. Calculating the increase in the money supply, well, we're going to use the following equation. The change in the money supply, or the total change in the money supply, is going to be 1 over the required reserve ratio times the change in the amount of reserves or deposits that go into the institution. So the change in the money supply, it's 1 over 0.20. We inject $100. We have $5 as the money multiplier times $100. That creates $500 in total money supply, using the following equation. The change in the money supply is equal to 1 over R times the amount of reserves that have changed, however many reserves were injected, or however many deposits increase. That's why I have here change in reserves or change in deposits, because it can come from reserves or from the deposits that are into the financial system, depending on how those deposits are used. So the change in the money supply is quite significant given the original increase in reserves. Now, the simple money multiplier shows how the money supply will increase through the financial markets, through financial systems. Now, the money supply can also expand or can suffer from what is called a cash leakage, meaning that it occurs when the funds are held as currency and not deposited into a different account, or if you send it somewhere else. For example, if you don't spend it in your local economy and you send it somewhere else to a different part of the world, or you just keep it safe, or you just do not deposit the same amount, it's a cash leakage. It goes out. So for example, Jill pays $500 to Joe. Joe, in the previous scenario, deposited the original $500 into the bank, creating an additional deposit, which creates reserves, and then those reserves are lended out and the process continues. But if Jill instead, if he only deposits $200 and keeps $300 in currency, well, the deposit will be smaller and the cash leakage now is $300. We don't know what he did with those $300. He could have saved it, he could have sent it somewhere else. That could happen, and the money multiplier becomes smaller. The amount of money that can be created is smaller when there's cash leakage. Now, the money supply process is very important because it can expand the money supply and it can also contract the money supply, which means it can make it smaller, it can contract it. And the contractionary monetary policy contracts the money supply, it decreases the money supply in the market. This is done through either by decreasing the amount of money supply in the market through government purchase of government securities, and it's considered open market operations sale, the selling of government securities by the Fed into the market. If the Federal Reserve sells securities, they are selling a Treasury certificate to the banks, and the banks are paying for that certificate with reserves. Basically, they're taking away the reserves cash, they're taking it away from the banks, and the bank is getting a certificate. Basically, that's going to be sitting on the bank, and you cannot lend that certificate. They're going to just hold the certificate, and the bank is going to pay with their reserves to the central bank, and the central bank simply holds that reserves in the bank. So if the Fed here undertakes an open market sale, it's going to sell $400 worth of government securities to Bank of A. And the Fed is going to take $400 of actual cash reserves. They're going to take $400 million or $400 in the cash reserves, actual currency, actual reserves from the bank, and provide them with a certificate. Here's your certificate that's worth $400 or $400 million, and we're going to take your actual cash reserves with us. That's an open market sale, open market operations of selling government securities, which is going to contract the money supply. because you're taking away money from the banks. You're taking the ability of them to lend. And instead, the Federal Reserve gives them a certificate. Now, what to do here, notice how we had our $10,000 in deposit, and the reserves were $1,000 out of the $10,000 deposit because we're keeping 10%, and they were lending the difference, 9,000 in loans, and our reserves are now smaller. We have 400. We have 600. What happens to the other 400? Well, the 400 were taken away by the Fed, and they gave us a certificate. Here we should have a certificate which says securities of $400, which is just there. You cannot sell it, or you cannot lend it. I'm sorry, you can sell it, but you cannot lend that certificate. You can sell it later. But you have taken away $400 in reserves. That security now is worth $400, but you now have smaller reserves, and you have shrunken the monetary base from the bank itself. So the reserves have gone from 1,000 to 600. Bank of A is now reserve deficient. So meaning that if it needs to maintain that 10% ratio, it will have to borrow from a different bank. It can try to borrow from another bank if it's reserve deficient, and that takes away reserves from a different bank, meaning that the reserve starts to decline. Or they can get a loan from the Fed directly and pay them interest and so on, or simply borrow from other banks, or request some adjustment with the Fed. In this process is an attempt to contract the money supply, which later will actually contract consumption and economic activity when you contract the money available in the market. So the money supply contraction process, as a result, declines by $400 because the banks lose the ability to use those $400 for additional loans or potentially additional deposits. If we decline the money supply by $400 by taking away reserves, how much would the checkable deposits decline? Well, we can use the money multiplier as an expansion effect to see how much money increases, and we can also increase it to show how much money will contract if we take off reserves. So here we have checkable deposits will decline because we are taking $400 off the cash reserves that the banks were using for lending. Remember how we borrowed $400 from a different bank, so that bank now has $400, or our bank has $400 less to lend? Well, that's going to change the reserves negatively. You're taking away $400 from the banking system. Our money multiplier is 1 over 0.10, 10%. So we need to keep 10% of those deposits. So we have a multiplier of 10. We have now declined the total money supply in the market by $4,000 because it creates an adjustment process. We take away $400 from our bank reserves that we could have lent. Well, those deposits are not going to occur anymore. So you're contracting the market completely. You're taking away potential deposits that could occur but are not occurring anymore because it's a reverse policy. It's a contractionary policy. You're taking away the ability of the banks to use those reserves and contracting them and giving them as security. And that security pays interest and can later be actually traded in the market. But for now, you have taken away $400 and provided security. Now, the Fed has important monetary policy tools, and it has the required reserve ratio, which means that it can lower the reserve ratio to make it smaller so the banks can lend more. But that puts them in a very severe situation because they keep low reserves and have a lot of loans. Or they can raise the required reserve ratio, and that limits the ability of banks to lend because they have to keep more in their bank vault. So the main policy tools and actions by the Fed is the required reserve ratio, which is actually really low in real life. It's like 2%. And the FDIC guarantees that your deposits are guaranteed up to $250,000. Now, it can also offer discount loans to banks. It can influence the discount rate, the discount interest rates. It can affect the federal funds rate, and the federal funds market. And of course, it engages in open market operations through the buying or selling of government securities to influence the monetary supply. Major tools of the Fed, either or. Buying or selling government securities can either expand or contract the money supply in the market. Let's take a look at the discount rate and the federal rate and what the difference of those are. The Federal Reserve can actually lend to banks in case they run out of cash reserves or out of liquidity through what is called a discount loan. And a discount loan is the Fed makes funds available to commercial banks at a discounted interest rate. Basically, if any bank, like Bank of America, goes into trouble and runs out of reserves and cannot meet those reserves and does not have enough funds, they can borrow directly from the Fed at a discounted rate. And the discounted rate is the interest rate the Fed charges the financial institution to borrow from them, from the Fed. And this is considered a discount loan. It's a discount loan because the bank is borrowing from the Fed at a discounted rate. And banks will only go to the Fed if they find themselves in some severe situation or in special conditions that they would really want to borrow from the Fed. It's like, for example, as an individual, when you run out of cash, you borrow from your friends, colleagues, or someone that you're close with. And then if you really run out of money, you borrow from your mom and dad, right? And if you're really, really struggling, you borrow from your grandma. This is Big Daddy for Bank of America. They borrow from the Fed if the other banks wouldn't lend them money anymore. It's the lender of last resort, borrowing from the Fed. And it could also lend money to the government. The federal funds rate means the banks can borrow directly from each other. Typically, if they run into trouble, they can borrow from one another, and they do so all the time at what is called a federal funds rate. At the federal level, banks, commercial banks like Bank of America, Chase, Wells Fargo, can borrow funds from each other if they need those funds. And that's considered the federal funds rate. The interest rate in the federal funds market that banks charge one another from borrowing reserves. It could be overnight or for however long they need them. That is established in the federal funds market, which is basically the market in which the banks pay one another, the interest rate that banks pay one another in the federal funds market to borrow or access each other's reserves for a short term of time. And the federal funds rate is targeted by the Federal Reserve, actually. They're set the federal funds rate within financial institutions. And as a last resort, if they can't borrow from one another, they can auction reserves, or they can borrow from the Fed if they really run into trouble. Thank you for the session. Have a good afternoon. We'll continue next time.